Welcome. You're listening to the Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Honf of Pacific Private Money, California's fastest growing mortgage investment firm, and Rob Spinoza of RPM Mortgage. Today's trivia theme is, as I always love that, the eyes suddenly come up. Okay, what's the trivia theme? Famous historical trials. So that'll be kind of fun.
All right.
Our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. We're also on television, Comcast Channel 26 and AT&T 99 on Saturdays at noon and Sundays at 6 p.m. Today we have a special guest, John Blumenthal, who is going to discuss, you ready for this? What's so funny about a midlife crisis, or in my case, how to have a midlife crisis. John, welcome to the Best of Investing.
Hello, Ed. Can I guess the trivia question?
Not yet. I haven't answered it yet. Okay.
It's not Jeopardy.
I know a lot of trials.
Okay. All right.
And tribulations.
Okay, so now, get this, guys. So, first question I want to ask you is, how did you manage to survive 8 years at Playboy magazine? Because apparently you were an editor of Playboy magazine.
I was quite a long time ago. It was a great job. They didn't care what time you left. You were supposed to do. You could do just about anything you wanted behind your door.
It's kind of like the mortgage business.
Sundays, Jeff and his, ladies. It was fun. What can I say? I want that job.
It makes for great conversation, if nothing else. I mean, 8 years has got to produce a lot of stories.
It does. You met some interesting people. It was fun.
But now you had here about trying to relive. There was a question you have here that says, why trying to relive your past could be the worst idea ever. I mean, for me, my midlife crisis is I ended up getting a Vespa. You know?
A Vespa?
No, well, kind of close.
That's the midlife crisis. You're on the wrong way.
So John, tell us.
Yeah.
What about reliving your past? Why is that the worst idea ever?
Well, it may or may not. I mean, it's like, some people buy fast cars, usually guys. Some people have an affair. Some people travel. Some people start going places. It depends on, midlife crises don't happen to everybody at the same time. I mean, if you were literal about it, everybody lives to be about, your midlife crisis would be 40, but I think it's actually later.
Yeah, I would agree with that.
I know. Yeah, you know what? I'll bet the midlife crisis is actually, it has gone up, hasn't it? Most people, they get it when they're mid-40s, and now it's probably, they stay young, so it's probably when they get into their 60s, they finally have a midlife crisis. Would you agree with that?
It's more like a three-quarters life.
Yeah, that's why they
Don't
call
tell
it
anybody.
Now, John, I was going to say that you had in here also about the definition of a half virgin, because you've written a book. Apparently it's a bestseller called 3 1/2 Virgins. So give us, what's the definition of a half virgin?
Well, first let me just say here that this is a clean show.
Yeah, that's right. Even though we got a former Playboy editor on the phone, this is a family show.
Exactly.
So go ahead.
My turn now?
Yes, go ahead.
Okay. Well, the cover has 3 1/2 cherries on it. There's 3 that you can see that are whole cherries. And then there's a cherry that's cut off at the bottom, so it's a half a cherry. But I can't really tell you what half a virgin is, because if I do that, it'd be like a real spoiler, and nobody would buy the book.
Okay.
It would counterproductive with tease.
Okay.
It's not like she was in half. It's not grotesque,
Okay. Okay, so what else can you tell us? Okay.
I can't take this in any clean direction, so I'm staying quiet here.
Well, okay, the title of this article was "What's so funny about midlife crisis?" Do you want to elaborate on that?
Well, there's, a lot can be kind of funny about it. It's, if you decide to have an affair and you're 62 years old and you have an affair with a 25-year-old woman, then your secretary, or whatever, 32-year-old woman. That can be funny, at least to other people.
Right.
not to the wife, and not to the kids.
Not to the wife. Not to the wife unless she's doing the same thing. But
well, then it's funny to everybody.
The The book is basically about a guy who, turns 40 and his wife leaves him for the guy up the block, and he tries to date, and that doesn't work. So he starts thinking about these three women in high school, and then he realizes that he broke their hearts. They were all virgins, and he decides to seek them out and apologize. And it's kind of like going back into your past, and the results are kind of funny, because everybody reacts differently. All the women react differently.
Yeah, are you calling from a cell phone?
No?
Really? Because it's funny, you're cutting in and out, and I don't think there's anything wrong with the mics.
Oh, no, I'm in a landline. I should probably stay closer to home base here.
Okay.
What was I saying? Yeah, I wrote a piece for Huffington Post. It was called, well, I told him about it, but it was basically about, if you're sitting in an outdoor cafe or something, you're looking at a people parade going by, you see a guy who's clearly about 60, and he's walking down the street with somebody who's clearly like 25. It's got bad connotation.
Right.
They basically think of him as a dirty old man. On the other hand, if you see a 45-year-old woman walking down the street with a 25, somebody who's not much older than her son, if she has a son, it's not quite as much of a stigma. It's like nudge, nudge, wink, wink. She's a cougar.
John, I'll tell you what,
Exactly.
we're cutting to our first commercial break here. We're going to let you go, but you have this book again. It's called 3.5 Virgins. All right, John, thanks again for joining us.
Great
on the
to
Best
talk with you,
Investing.
John.
Well,
Boy, I'm sorry. You know what? I know in the past I tell people don't call on a cell phone. I didn't think to have to say, if you're calling from a landline, make sure that you're close to the base. Because half the thing I couldn't even hear.
right, he
Okay.
kept cutting out. Sorry about that, guys.
Yeah, sorry about that, audience. But hopefully you got.
Stay tuned. It's going to get more exciting. We promise.
Yeah.
It definitely is. Okay, we're going to cut to our first commercial break, and the theme again is famous historical trials. What snack food was linked to the defense used by Dan White in his trial for the murder of Harvey Milk and George Moscone? Call 888-912-1190. That's 888-912-1190 to answer this question. What snack food was linked to the defense used by Dan White in his trial for the murder of Harvey Milk and George Moscone? Don't touch that dial. The Best of Investing will be right back. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money, and Robert Spinoza of RPM Mortgage. When we cut to the first commercial break, we asked this trivia question. Again, the theme is famous historical trials. What snack food was linked to the defense used by Dan White in his trial for the murder of Harvey Milk and George Moscone?
That would be the Twinkie
The
defense.
Twinkie defense.
Indeed.
That is correct.
That hits close to home here.
Let's get right into email time here because, Robert, we got an interesting one for you. A lot of people, I'm sure, this being March, this question is apropos.
Okay.
I would like to refinance, but I haven't completed my tax return yet. What do I do?
Great. Okay, good question. So this is the time of year where obviously everybody is in the process, or most people are in the process of filing their tax returns, April 15th deadline. Some people will file on extension, but we're not going to talk about that right now. Let's focus on you're in process, and if you are a wage earner, meaning you get a W-2, you get a pay stub, and you're not qualifying on any bonus income or hourly wages that need to be averaged, and certainly if you're not self-employed, then what's going to happen is most lenders, by and large, are going to use the W-2 you got for 2013, along with your previous history, so 2011, 2012, and that will be fairly consistent in most cases. They'll qualify off that. Now, if you have a situation where you need to use the income that you earned in 2013 that will vary in some fashion from previous years, you're in a situation where the lender is looking to not only underwrite your tax return, which you may or may not have, but they're also going to pull a 4506T, which is the IRS request for transcript. And when they do that, if the IRS has not yet processed your return, it will come back with no record. So the bank making the loan is not certain that what you filed is actually what the IRS has received.
Yep.
So what you need to do if you're in this situation now, what I advise is that you get a stamped copy of the return. So you actually have to go through the inconvenience of bringing it to the IRS office, get a stamped copy, and then provide that to your lender. And then what's going to happen is the lender is going to know that this was authenticated in receipt by the IRS, and they will go ahead and they will review that. Now, if you have a wild fluctuation in income upward, you can expect your lender to push back a little bit on that if they can't verify it with the IRS. Okay? So in those situations, consult your loan advisor. If you have additional questions, certainly let me know. I'm happy to walk you through any nuances of the way it may be for you. But know that this is just part of the time of year, and until the lender has both the return and the 4506T executed, they're looking to do a little extra due diligence to make sure what you're submitting to them is what you're submitting to the IRS as well.
Fair enough.
Yeah, that's how it works.
Yeah, in this day of TurboTax, and
Right, so
you can have two
good point.
returns, one for the IRS and one for your bank. Hey, I made all this money last year.
No, I didn't.
How come it's not in your bank?
So yeah,
the mattress.
and that's how you get around that. If you file with your TurboTax or you're Intuit or whatever it may be, then the lender doesn't have a record. So you want to avoid that at this time of year.
Okay. Fair enough. How do people get a hold of you?
They can go on to the Best of Investing website.
Okay.
And sharp dressed.
Thank you.
Yeah, that's true. I gotta say, out of the three of us, he is definitely the most handsome of us. Okay. Mark, we have an email here from you from a listener who says, I've heard you mention that your fund is paying over 8%, but what are my risks of investing in it?
You know, it's funny. So that person is writing, asking about the mortgage pool fund that those of you who've heard us before may have heard us talk about on this show over the last year. So at Pacific Private Money, we have a mortgage pool fund we call the Pacific Private Money Fund, and it is essentially a lending device that we use to make loans to real estate investors. That fund is funded by private individuals who contribute to that their savings or IRA accounts. They invest in the fund. We sell shares in the fund, and we loan money out to real estate investors from that. And so we've got right now our average loan to value in the fund is at 63% loan to value.
Nice.
So the
Very
fund
conservative.
it's a fairly conservative loan to value when you consider that banks for years have been making 80% loans. I mean,
Right.
everybody knows about if
Right.
you're going to go buy a home, you can get an 80% loan.
And that's
You come
considered
to-
safe.
Right, and,
Yeah.
and you put in 20% down. That's your skin in the game. That's the equity slice.
Right.
The bank has that 20% protective equity. Well, in private lending, which is sometimes also referred to as hard money lending, when we're making loans to usually non-owner occupied real estate in California, typically purchased to remodel and flip or purchased to hold for rental income. That's typically the type of property we're lending against. What's different about our loans is that we typically don't go higher than 70%. That's our maximum, generally speaking. There are exceptions.
Well,
that
and
are-
also, this is a, either rising or,
Right.
flat, worst case scenario market. We're not in a declining market.
Right.
So that's even more conservative.
Mark, I was going to ask you, is everything in the fund residential, or is there any commercial in there?
There's some commercial, and we
Okay.
usually small commercial, so
Okay.
it's not a
Like a
big,
mixed use
it's not,
sort of-
it's not $1 million
Right.
loan, it's a $250,000 loan on a mixed use or a commercial
Right.
building. We've got one loan in there that's, essentially the tenant, it's an owner user
Right.
for
Right.
that, so they're looking forward to getting an SBA loan, and that's how they intend to pay off this loan
Right.
within a year, but meanwhile, they're using our loan as a bridge loan. So the question is, so how safe is that investment? Well, for example, I got a phone call this week where a woman calls and says, well, how safe is it? Well, I said, I start responding to her, and she said, no, I asked you a simple question. How safe is it? And I knew right away I was talking to someone who really is looking for some kind of FDIC insured,
Right.
your money's guaranteed against loss. There are no guarantees against loss in most investing unless you invest in certain types of government bonds, right? Or if you
Okay,
put your
but you
money
can
in a
earn
bank
a
CD, right?
fraction of a percent.
So-
But you also have interest rate risk with those, because
Sure.
if you invest in a 30-year bond
It erodes
today,
inflation erodes the value.
Right.
of it.
well, not
Yeah.
only that, but the thing is, if interest rates start going up,
Yeah.
the price of that bond is going to plummet.
Plummet,
And the
yep.
only way that you're guaranteed is if you hold the bond until interest rates
Maturity.
either drop
Yeah.
or you keep it for the whole 30 years.
Yeah.
So, you're guaranteed. In that case, the government will guarantee to print more money.
Right.
Right. So principal guarantee is a big issue in investing, obviously. And the older you get, the more concerned you are with preservation of capital or principal protection. Well, the stock market offers none. We know
Correct.
that. You can lose everything, and many people do when a stock goes bust. Of course, unless you're in mutual funds, but then you're subject to the swings of yield. What are you making year over year? And we know what's happened over the last 10 years in the market.
And
So
I remember in 1987, some mutual funds dropped 25% overnight.
right. So what we're offering is not a publicly traded investment vehicle. It's what's considered an alternative investment. It includes things like, well, real estate's an alternative
Right.
investment. It's not a liquid investment. And mortgage pool funds or trust deed investing, which is also a form of private lending, all of these are referred to as alternative investments. People oftentimes through their self-directed IRA will invest in these types of generally high-yielding opportunities. But the safety and security features of a mortgage pool fund like the Pacific Private Money Fund are the fact that we make loans with a lot of protective equity, much more than Wells Fargo, Bank of America, Chase, or Citibank do when they make a loan. Our loans are identical in terms of the documents we use. The note and the deed of trust are identical to what the banks use. Our underwriting and the disclosures, all of that are, well, the underwriting's not identical, the disclosures are identical. Our underwriting is different because we look at
focus
different
is different,
factors.
right.
The focus is different, right? We're focusing on different variables in the bank. The banks look at numbers. We look beyond the numbers to the safety and or basically the exit strategy
Right.
for the person who's borrowing the money, because our loans tend to be short term. So again, I apologize for making it this a long-winded long-winded answer to a simple question: how safe is it? We have protective equity, so the market would really have to tank again, like it did in 2008 and 2009. What's the likelihood of that? I don't
I think
know.
it's very small.
I think it's very small, given that the air has largely been let out
That's
of
right.
the inflated
Yeah.
prices
but
already.
also it has to, I think it has to do more than that, because even when prices plummet, not everybody just walks away from the property. They
Right.
think, I want to hold on to this because the market's going to recover.
But
They'll continue to pay.
I agree with you on that, and I also agree now that we've seen in recent past, and people are kicking themselves now when they watch Blackstone pick up all of this property and put it back on the market as rentals. So if we had a downturn like that, one has to wonder, would these investments become more appealing, and would people be looking for those financial vehicles to get into them more than they are now, with prices a bit higher?
So the way we cover, the safety features in a fund like ours is very few of the loans in the fund are longer than 12 months. Many of them get paid off within 4 to 6 months. So the real estate market doesn't generally crater in a short. In fact, it's never cratered in a 6-month period.
Right.
It can go down. I mean, look how many years it actually took for the prices to go from the peak, which was generally considered right around 2007, somewhere
Probably
in
early
2007,
'07, yeah.
and the bottom of the market, the initial bottom. Some argue maybe we had a double dip, but the initial bottom was right around 2010. So we're talking about a 3-year period
And you
where
don't
prices went down.
You don't do 30-year loans.
Well, I also wanted to say one thing about the person that called you, and that is, you have to be careful when you are asking how safe something is, and you are relating it to something that it's not related to. So
Right.
if you're saying real estate and you're thinking about your primary home and your first mortgage on a primary home, that is a world removed from a private money loan for an investment purpose. It's not the same thing, even though it's real estate.
So what
It's
also,
not the
he's
same
not
thing.
lending in Detroit or Cleveland.
Right.
He's lending in the Bay Area. And
So the net result of the question is really the way I want to answer it is we take the fiduciary responsibility that we have with our shareholders very, very seriously, which is why the weighted average loan to value in our fund is presently 63%, and we don't ever expect it to even hit 70 ever. Number one. Number two is that we're producing yields between 8 and 9%. We're right at about 8.5 right now, and I don't know of any other investment, and I'm familiar with all the other companies in California that are doing similar products, and I don't know of any other mortgage pool investment opportunity right now that's paying 8.5% that has the safety and security features that we have with our Bay Area weighted mortgage pool fund. And so,
So
for more,
don't keep us in
so
suspenders.
for more, yeah,
All
so
you-
for more information, again, this is not something I'm trying to beat people over the head with and say, oh, you really need to invest in this, but you really need to investigate the opportunity. I think if you want to boost the savings you're earning in your portfolio, your savings portfolio.
Very good.
Yeah.
Okay, we're going to cut to, in fact, when we come back, I want you to get into the deal of the week because you won't believe the kind of deals that Mark gets. The question, I'm sure people are listening if they're listening for the first time.
Tell us about a loan.
Yeah, I mean,
Yeah.
how are you
That
getting
is
8.5%? Okay, and why are these people borrowing at that rate? Okay, so here is the
Because they're crazy.
they're crazy to make money.
They are, absolutely.
Yeah, 'cause
Crazy
they're-
about making money in real estate.
They're going to borrow at one rate from you, but they're going to make a lot more than that.
Heck yeah.
Okay, so here is the second commercial break trivia question. Again, the theme is famous historical trials, and I think these questions are getting just a little bit harder than the
Oh,
first
boy.
one. Which one of the founding fathers was an attorney for the defense of British soldiers for the Boston Massacre? The first three callers, put your hand down, Ron.
I know this
The first three callers, and I'll tell you why I know this. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. 888-912-1190 to answer this question. Which one of the founding fathers was an attorney for the defense of British soldiers for the Boston Massacre? And the Boston Massacre, by the way, only 5 people died, so it was a massacre, but it was a small massacre.
If you're one of the 5, it was
Yeah, it was a big massacre.
Really good marketing on that name there.
Yeah, thank you. Okay, don't
Wait,
touch-
you didn't come up with the Boston Massacre.
Don't
saying-
touch,
yeah.
don't touch that dial. The Best of Investing will be right back. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. When we cut to the second commercial break, we ask this trivia question. Again, the theme is famous historical trials. Which one of the founding fathers was an attorney for the defense of British soldiers for the Boston Massacre? And Mark,
Nope, I don't know that one.
John Adams.
John Adams, that is correct. And what did you say about marketing? That instead of calling it the Boston
Well, it's
Murder?
yeah,
Call
it's
it
the Boston Massacre. Make it sound like hundreds of people
hundreds
were
of
blown
people,
away.
yes.
Appendages flying everywhere.
Mark, before we cut to the break, I told people that you were going to tell us about the deal of the week because again, your fund is paying over 8%. People are probably wondering how can you do that. Again, we got into the risks, but why are these people borrowing from you? Give us an example.
Well, instead of a specific deal, because you caught me a little bit unprepared, Edward, there. But what I'm going to do is give you a couple of examples of deals we've done recently. That as opposed to the deal next week, I promise deal of the week. So essentially, the loans that we're making are usually to guys that are buying, fixing, and flipping real estate. Okay, so no secret that that's been very, very popular since the market bottomed out around 2010 and 11. Now, at Pacific, we've been writing loans since 2008. So we started making loans to people, early as the market was beginning to dip, and even though the market was still going down, our foreclosure record after over 600 loans is only 2 loans. So we're talking about almost an insignificant foreclosure rate, and both of those foreclosures, the lender who ended up with the property was very happy to have that property, so there was no money loss. So again, just to give you an idea, these people can and have lost money in prior cycles, making crazy seconds or high LTV
90%,
seconds,
yeah.
right, on which was hard money used to be. And while we do sometimes make a second, the 95% of the funding we do are first position mortgages, and most of those are first position purchase mortgages. So we're really serving the community of real estate investors who want to buy real estate for the purpose of making a profit, or holding it for rental income, and they've gone to the banks, and the banks either aren't making those loans anymore, which is typically the case, or because of the way the market is right now, you generally, to get a good deal, you have to make a very aggressive offer with a fast close. So banks are generally not set up to close, in less than 21 days, and some can't even accommodate 21 days. And many of the folks who come to us to borrow money are looking to close next Friday.
Right.
They've been in contract for a few days, and maybe they were going to go to their bank, and they abruptly found out that, sorry, we can't help you.
Well, they found out something like, well, we can't even get your appraisal ordered until we send out all these disclosures that are now required by law, and that's going to take a few days, and then you have to consent, and then we can order your
And the
appraisal.
seller is anxious to sell,
Right.
and this buyer is getting a smoking deal on
Right.
the property.
So why would someone pay the kind of rates we're charging? And we generally charge, our average loan is 10%. So
Okay.
some are a little bit less, some are a little bit more, but generally speaking, 10% is a very typical cost of a private money loan, also known as a hard money loan, in the San Francisco Bay Area. These are generally short-term loans, usually 6 months, 12 months, sometimes 24 or 36 months, but by and large, the strongest demand for this short-term private capital that is not available through the banks in today's market, and we don't know if and when the banks will come back and try to compete in this particular market. I think the private money market has really developed over the last several years to provide short-term capital to real estate investors, and the cost is what the cost is.
Right.
Real estate investors just factor that into their budget. They know that if they're
Right.
going to get a hard money loan, they're going to borrow $100,000 to buy a property in the East Bay that they want to fix and flip. It's going to cost them anywhere from 3 to 5 points. 1 point equals 1%.
Right.
So let's just say we usually charge 3, so it'd be $3,000 in quote origination points, maybe $1,000 for documentation and processing, and they're going to pay 10% for that money
Right,
for as
right.
long as they're using it. And if they can fix and flip the property in 3 months or 6 months, or maybe it takes them 8 months, however long that is, that financing cost is going to be built in, or should be built into that budget, and we usually make sure it is.
But again, I want to say this because my mic won't pick it up anyway. No, I want to
Mic
say
check.
I want to say this because it's very different than residential lending in the sense that with residential lending. Well, Edward, why don't you go ahead and finish my point?
Well, with residential lending. Go ahead.
No, I can't. Is that better?
Yeah, that
Okay.
works. Here,
So
go.
with residential lending, I think if you are listening to the show and you're thinking, well, I have a 30-year fixed rate loan on my house for 3.75%, and Mark is telling me I can get a loan for 10%. Oh my God, it's not the same thing. It's a solution-based lending, whereas when you're borrowing against your primary home to live there for a long time, that's not what an investor is doing there. They are looking at that like a financial equation. They're factoring in the cost, they're factoring in the debt service, they're factoring in the remodel cost, and then the exit strategy, what they're going to do. Are they going to sell it down the road, and at what price? And that's the difference, and you have to view it in that light.
And could you, Mark, can you give us an example of something that you've actually recently done? Because you gave us like the typical situation.
Well, actually, you know what? I wanted to actually continue on in just a different realm. I talked about the type of loans that we're generally doing, but the other question is well, aren't you making loans to borrowers with ruined credit? And the answer to that is not always.
Right.
We have
right.
a lot of borrowers with 700 plus FICOs. In fact, we just funded a deal the other day. It was a purchase money loan in San Francisco. They were paying about $1 million for this property, and of course, fixers in San Francisco, $1 million
Right.
is actually a bargain.
Yeah.
Oftentimes, and so we provided them with a $700,000 loan. We were able to close it in 10 days, and they paid a 9.9% rate, paid 2.5 points. The FICO score was close to 800
Wow.
for the primary borrower. And again, the reason they were doing this was because they knew that we could close within 10 days, and
Yeah.
they can't get bank financing. So it's
Right.
not like they're grudgingly coming to us. I mean,
You found the solution.
there isn't a market really between our 10% private money and the 5%, let's call it 5%
Right.
bank money.
Right.
There's really nothing in between right now, and the reason is that just happens. That 5-point gap actually is historically speaking the average spread between bank financing cost, the bank rate, and hard money rates.
Mm-hmm.
So consider that prime, not that long ago was
Right.
between 6 and 8%,
Right.
and hard money was between 12 and 13%. So
Well,
hard
here's
money
the other
prices
thing.
have gone down a bit.
It's amazing how many people who actually can go to the bank, they just won't because of all the red tape. Please, Mr. Jones, explain to me why there's a $300 deposit.
Right.
I'm going for a $3 million loan, and you're
Right.
asking me why there's
Right.
a $300 deposit? They just don't want to deal with them.
Right, so people come to me who aren't familiar with what we do, but and it's usually like someone who's considering making an investment in our fund. They'll go, "Oh yeah, I know, I've heard about what you guys do. You make seconds to people who are in trouble." Well, no, that
Right.
Here's the thing. Hard money that most people remember from 10, 15, 20 years ago, that business model is gone.
Right.
It went the way of subprime. It doesn't
Oh, yeah.
exist anymore.
Yeah.
It was regulated out of business. We're not allowed to do predatory seconds to homeowners. We can't. It's illegal to do that today. Dodd-Frank killed that
Yeah.
business model. It cannot be. You can't legally make that loan anymore.
I'll also bring up 2 points from the residential perspective to kind of follow up on what Edward said, but also on your scenario where you have a $700,000 loan and you're looking to remodel the place, I believe you said.
Right.
Okay, so that would be considered a jumbo loan, number one. And number two is that would be an investment property, a non-owner occupied jumbo loan. And those are not that easy to come by in the residential environment right now. Even though we've seen a lot of jumbo product come back, there are not a whole lot of investors in that game. And there is a premium for those loans.
Yeah, how much?
Yeah, so
what rate are we talking about?
well, I
Like
would think
6%?
you're getting there.
Yeah.
You're getting there with some investors. I mean, you may find it more aggressive than that, but if that property needs to be remodeled and is not in condition to even appraise, the question is moot because you're not going to get a residential mortgage lender to make a jumbo loan with anything other than a stellar appraisal. So there you go. I mean, you've got to go that route.
And does that bank want their money back in 6 to 8 months?
Yeah, that's the other thing.
No,
Maybe a huge
right.
defeasance. Ooh, that's sophisticated talk there.
Avoid that at all costs.
Yeah.
It just sounds bad.
Yeah.
Listen, I have a credit default swap loan
Right.
on one of my properties, and when interest rates went down, the prepayment penalty was going to be $200,000. Oh, scary.
Yep.
Thank you, Mr. Banker. Okay, so here is our third and final trivia question. Again, the theme is famous historical trials. Which famous historical figure went on trial for heresy in the year 1431? The first three callers with the correct answer, and it was not Bill Clinton. The first three callers with the correct answer win a free 3-day, 2-night stay at the Lighthouse Resort. Call 888-912-1190. That's 888-912-1190 to answer this question. Which famous historical figure went on trial for heresy in the year 1431? Make sure to include, we're going to party like it's 1431. Prince, right?
Yeah,
Make
exactly.
sure to include your name, your email address, speak slowly, spell out your email one letter at a time. When the best of investing comes back, we have a couple of interesting articles and some thoughts for the day. Away we go. Welcome back to The Best of Investing. I'm Edward Brown, your host, along with Mark Hahn and Rob Spinoza. When we cut to the third and final commercial break, we ask this trivia question again. The theme is famous historical trials. What famous historical figure went on trial for heresy in 1431?
Can you give me a nationality maybe or something?
It's a woman.
Joan of Arc.
Joan of Arc.
Ah!
That's why I said historical figure.
Ah!
Very good.
I think I was 3 for 3 today.
Yeah, well, yeah, with a little help from our friends.
Ah.
Okay, that's okay. I'm teasing you. Okay, Robert, you have an interesting article that you were starting to share with us off air. Bring it on air.
Well, Mark prompted sort of an idea I had that is worthy of discussion, I think, and I have an article to support it. But we were talking about FICO scores and credit and borrowers and their FICO scores, what sort of eligibility that brings into play. What I've noticed recently, though, I find extremely curious, and that is the average FICO score of my borrower is actually going a bit down. And you would think in this environment where the restrictions are ultra restrictive,
Yeah.
that you would only see it going up.
or just with the economy going up, you would think.
Right.
In fact, I heard that the average FICO or that the average loan closed, the borrower had a FICO score of, and I heard like 740 at one point, maybe
Okay.
6 months ago.
Okay.
But you're saying that's trending back down again, at least in your anecdotally, you're seeing lower scores.
I see that in my pipeline. Hey, maybe
That
that's
doesn't
just
surprise
maybe
me.
that's just me.
No, but, well, are the banks loosening up and going to lower
Well,
ones?
yeah, that's a great question. So I think what's happening. This is me, and I've talked about some other people, talked about it with other people, and they've also said that they're seeing similar things. What I think is happening is the increase in home equity is bringing borrowers back into the mix that were previously shut out in 2009, 2010, 2011, because they were thinking, hey, I don't have equity in my house, so I'm not even going to attempt to refinance or purchase. I don't have the down payment. But in the case of a refinance, now they're saying, well, I've gotten some of that equity back. That's been restored. So now the only limiter is my FICO, and I'll take a shot at this because I'm stuck at this loan at 6.25% or whatever it may be. Maybe now is the time to get in and try. When I pull their FICO, I reveal that, okay, you're under 700, where, I remember 2008, 2009, every loan I pulled, it seemed like I was getting an 800 FICO score because they knew they were the only people that could get a loan.
It's interesting that
Interesting.
the article you brought in here, which started the conversation, says number of Bay Area homes with underwater mortgages tumbles. I noticed that was the article in the San Jose Mercury News.
Right.
So what's happening in San Jose right now in Silicon Valley?
Yeah.
Home prices are skyrocketing.
Yeah.
And it's true. The number of homes, the number of people with homes who are strategically or technically underwater, meaning they may not actually owe more than it's worth, but there's not enough equity for them to actually sell the
Right.
property and have any cash to be able to buy the next home. So there's still a lot of people locked in, and I know that's really that's contributing. The remaining homes that are still remaining effectively underwater and
Right.
locked out. It's really affecting the amount of inventory on the market.
Yeah, it is, and to get to Edward's point about the FICOs, are banks are they more accommodative of a lower FICO score? We have a number of investors and programs, and I think what's very, very heartening is to see that the lending industry, at least at RPM, we are taking on new product that is trying to do make sense lending. So if your FICO is a little compromised, let's say you got a 680 FICO score, which is not all that bad to be quite honest, but you have a strong loan to value, then we're looking at making that loan. Because the appetite on the secondary market, whether that's Wall Street or in other places, they are looking for yield. And I think they are realizing that the real estate market can be healthy and has been healthy over the near term, and they're looking to make those loans if they make sense. And that's encouraging.
If I got a FICO score of 320, will you give me enough money to buy a tent?
No, but I tell you what we will do. If you have a FICO score of 320, we will print that out and we will post it in our building, and everyone that walks by will have. No, I'm kidding. I'm totally kidding.
Yeah,
we will
please
not
don't.
do that.
Please don't.
And if we do it, we'll black out the social. No.
So I want to black out the face and the name.
No, I'm kidding. We don't see a lot of 320s at RPM, but if you got one, and you want to take a shot at it, you will make somebody,
You'd have
a
to
good
try
trouble.
really, really
You would.
hard.
In fact,
to have
you wouldn't even
drop your
probably give them a
score.
loan.
I think I saw
Probably not.
I think I saw a 4 once before the downturn, and even that was like knock you back in your seat kind of. I've never seen
They
that.
should be proud of that. That's hard to do.
It takes a lot of work. You got to piss a lot of people off to get a 400 FICO.
Get a loan and immediately don't pay anything.
Well,
Wow.
certainly with the refi boom essentially done and over with, and we've had multiple cycles of refinance booms over the last 10 years, but no one really believes price, we'll ever see 3%, maybe not in our lifetimes again.
right.
So the banks are going to have to do something to make up for the fact that
It's not rate driven. Yeah.
Yeah, so really it's the ability to repay is going to be a big factor
Right.
in loans going forward, but I think they're going to probably relax FICO scores, and in fact it may surprise us as to how low they'll start to approve loans in terms of FICO scores as long as you've got the ability to repay, meaning
point.
you've got the income.
Good
If
point,
you can
because
document your income, it's stronger than a FICO score.
Yeah, FICO is not a factor in ability to repay.
Yeah.
I mean, the history of repayment is, but the actual score itself, there is nothing in Dodd-Frank that says you need to have a certain
Right.
number to get a loan.
That's exactly right, and that's
I don't think they will either because
Oh,
if it's
because-
a private company, FICO,
Discrimination would be, yeah.
Sure, and things change. Your
Right.
FICO goes down for one reason or
Right.
another. Gentlemen, thank you very much.
You're very welcome.
It was a very interesting guest we had in the beginning. Okay, here are
Makes
our-
for good radio.
Yeah, that's for sure. Okay, here's our thought. If you didn't catch it, then you'll have to listen on the podcast, Best of Investing. Thoughts for the day. In 2009, ABC News found a total of 119 different spellings of the Libyan dictator Muammar
wow.
Gaddafi.
Yeah.
Now, he should have changed his
funny.
name to John Smith.
my favorite was Gaddafi Duck.
I like that. Or we used to call, remember in 1979, the Ayatollah cockamamie?
Yes.
Okay, and a Rubik's Cube has 43 quintillion possible configurations. No wonder I still haven't figured it out.
Including the one where you pull it apart and put it back together.
No, you know what I do? I just paint all the cubes the same color,
Yes.
and I go,
I don't think
run.
I've gotten that done once.
I couldn't figure it out. Since 1983, I still haven't figured it out. Okay, tune in next week. That I tried every night. Tune in next week to the Best of Investing. We're giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown, wishing you the best of investing. So long. Welcome, you're listening to the Best of Investing on Talk 910, the show where we present valuable information about real estate, the financial markets, and other economic business of the day. But we're going to have a fun show today. We got some very interesting articles.
Great.
I'm your host, Edward Brown, and I'm proud to have as my co-host Mark Hanf of Pacific Private Money, California's fastest growing mortgage investment firm, and Robert Spinoza of RPM Mortgage. Our phone number is 888-912-1190. We're going to use that number to answer the trivia questions for 3 vacations given away during each commercial break. And today's trivia theme is, you ready for this one? Celebrity car accidents.
Okay.
All right.
All right. And our website is bestofinvesting.com. Check us out on Facebook and YouTube by typing Best of Investing Radio Show. We're also on television, Comcast Channel 26 and AT&T 99 on Saturdays at noon and Sundays at 6 p.m. This segment of the Best of Investing is brought to you by Crystal Bull. Rob, we told the audience ahead of time that we had some very interesting articles. Take it away.
I wanted to talk some about the current state of the real estate market. And I thought, we here in the Bay Area and in Marin in particular, but here in the Bay Area, I think we are always sensitive to the fact that our real estate economy makes a lot of other people think that we live in some crazy area, but we have some statistics.
Well, we do, but that's beside the point.
Yeah, but you look at the cost of real estate here, and you look at the trends here, and relative to other areas, and you have to keep them in perspective. But I think we've got some interesting stuff going on as we start the year. I know you've got some comments on that too as well, Mark.
I do, and so today's going to be a show about the real estate market, and I think first off is, what is going on in real estate right now? I mean, supposedly we've had all these articles that had said, real estate prices were up 20% in 2013. What's going to happen in 2014? Well, we talked in previous shows how that 20% increase was the median home price increase, not that your house's value necessarily went up, although some did. Now, there's some markets, some San Francisco neighborhoods, thanks to tech, and Silicon Valley neighborhoods, again, thanks to tech. Many of those neighborhoods are actually now trading at prices above 2006, thanks to tech.
Well, here's the funny thing is Google was the darling, and now there are a lot of people who are upset because the people who work for Google make a lot of money,
and they've helped drive up home prices.
Yeah. And then also the thing about the buses coming around, and well, in theory, that's really good for the environment. But these people are getting. Really
I've worked
upset.
with some Google borrowers, and they are one smart set. And I'll tell you what, if you live in a neighborhood where you've had an influx of Google people, thank them the next time you see them on the street, if you see them, because not only are they bringing your values up, but you're talking about a hardworking, smart set of individuals. That's been my experience with the Google folks. So Google, whatever you're doing, keep doing it. It's impressive to me on the borrowing side.
Well, on the real estate side, again, so the Silicon Valley market, the San Francisco markets, yes, the many neighborhoods are trading above the 2006 high now in 2014. Right. But most markets in the Bay Area are not. Most markets in the Bay Area are still well below the 2006 peak. There are still over 1 million homes in California that are fundamentally underwater. People are unable to sell because they don't have enough equity in their home to pay the cost of sales and to have any money left over to actually buy another house. So they're stuck. They'd like to sell. They'd like to move. They're like the idea of being upwardly mobile, but they cannot. And so, excuse me, we've got inventory that.
That's the word I was
non-existent.
going for. Yeah.
So the inventory right now is just ridiculously low, and it's mainly due to the fact that, well, 2 reasons. We're not building new homes,
right.
And our population continues to increase, and people living with mom and dad who are, in their 20s and some of them in their 30s. They want to move back out again. So there's demand for housing, but there isn't the supply. And people who want to sell, that can sell, that got plenty of equity, they're not going to sell because there's nothing for them to buy.
Right, they're in that situation.
So we're at a catch-22 right now in the real estate market, whereas we're not having enough new construction happening to add to the inventory. Dang it, sorry about that. And people we have this catch-22 with people unable to sell.
And it's a game of chicken too, is what I
Really
see
is.
happening. Is you don't know which way it's going to go. One of the interesting trends that I've seen, I'm with RPM Mortgage, and we make residential mortgage loans, and I see borrowers in a situation. They're in one of two situations frequently. One is they're being forced to look at price points that exceeded what they had originally thought. So they have to look up to find any inventory where they want to be. The other thing that I see happen, and I'll get a call per week from a real estate agent or a potential buyer, and they'll say, hey, we saw this house in fill in the blank, Sausalito, and it's in really rough condition, can I buy it? And we as a residential lender, we have some restrictions on the condition of property. It has to do with how it appraises, of course, but I see buyers having to go more frequently in one of those two directions, either up in price point, and we have some programs that are helping accommodate that, but also lower in quality, which is a dicey proposition if they don't have the resources to repair it or otherwise, find a way to get into it, which I know, sort of touches on what you do, Mark, as well.
So, the tight market for homes presently listed is a great opportunity for real estate investors who have the ability to find an opportunity. And when I say find an opportunity, I don't mean, go on the MLS or call your local realtor and ask them to look on the MLS for you to find something that you can buy. Because I'm telling you right now, you're not going to find a deal on the multiple listing service because those homes are being bought, if they're priced correctly, they're being bought very, very quickly, oftentimes with multiple offers. But we have at Pacific Private Money, we make loans to real estate investors. We're, hard money / private money lenders. That's our business model. Mm-hmm. And so we have a lot of repeat clients. And as much as I hear people complain who are real estate investors, they say, well, there's nothing to buy out there. I haven't been able to find anything that was priced correctly. For every one of those guys, I have another guy that's out there just gleefully rubbing his hands together because they know how to find deals, and many of them are doing things like literally knocking on doors of people who are underwater or in some form of pre-foreclosure, and because a lot of these people do want to move, they just don't know how.
It affects a lot of things, not only the stress on their marriage, but their job prospect and all. They can't take another opportunity elsewhere if they can't get out of their house without some severe consequences.
So there are still a lot of short sales going on in this market, and there are people who specialize, real estate agents who specialize in short sales that can help you with that. But really, it just takes a lot more work. And so the real estate investor who's savvy, and is willing to knock on doors and find opportunities not listed on the MLS, and there are a lot of them out there. And so there are still, I've got some repeat borrower clients. I can't believe, I'm amazed. They're calling me every week going, oh, and I got another opportunity. It's just like, oh my God, I should introduce a couple of my other, clients to you, and you could take them around and
hopefully don't get too
have your own
spread out.
private tour. Yeah,
activity creates activity in those individuals, which is really encouraging to see.
Okay, tell you what, we're going to cut to our first commercial break here, and when we come back, Rob, I want you to talk about that the gold.
Oh, okay, yeah.
Gold. I found gold. Okay.
Eureka.
Eureka. I found it. Okay, today's trivia theme is celebrity car accidents. Okay, in 1927, Isadora Duncan died when something got tangled in the wheel of the car. What was it? Call 888-912-1190. That's 888-912-1190 to answer this question. In 1927, Isadora Duncan died when something got tangled in the wheel of the car. What was it? Make sure to include your name and your email. Please spell out your email one letter at a time. Speak slowly. Don't touch that dial. The Best of Investing will be right back. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hunt, president of Pacific Private Money, and Rob Spinoza of RPM Mortgage. When we cut to the first commercial break, again, the theme is celebrity car accidents. We asked this trivia question. In 1927, Isadora Duncan died when something got tangled in the wheel of the car. What was it?
I'm going to say
Her
1927.
feather boa?
The horse.
The
It's 1927. Come on.
no, the scarf. Remember, she was the one who had the scarf around her neck. I guess the boa. Boa constrictor.
I'll give it to Mark.
Okay. Otherwise, it would be a snake if it was boa constrictor. Okay. Rob, we told the audience that we would talk a little bit about the gold.
Oh yeah.
And then you got another interesting.
Well, probably a lot of people here in the Bay Area or in Northern California have heard about this couple. They found $10 million worth of gold coins in their backyard. So they're out walking the dog, and they notice this shiny object at the base of a tree, and they start digging, and it's buried treasure. So now there's all this talk about, well, was this money that was stolen from the mint in San Francisco? Because we're talking turn of the century. But one of the interesting articles, or one of the reasons I found the article, is that one of their motivations was to pay their mortgage with this treasure.
It's called treasure trove.
So I was just envisioning the application as like, Dodd-Frank now says there's an ability to repay. How do you intend to repay this loan? Oh, well, we found $10 million worth of gold coins in our backyard.
I'm sure Dodd-Frank figured that out.
I'm sorry you do not qualify. It's not considered income.
It's not
Well, it is for tax purposes.
For tax purposes,
Man.
yes, it'll be ordinary income.
I think
but in terms of it's not wage income, which if a bank is doing an ability to repay,
Right,
if
there
you're
you go.
not working,
One time.
you still don't qualify
That's
for a mortgage.
true. That's a good point.
Funny.
Say, screw it, I'll just pay off the house.
Yeah, and then some. Apparently, the is it a numismatist? Do I have that right?
Yeah.
He
Numismatist,
is here in Tiburon, who's looking at that thing. So it'd be interesting to see how it plays out. I don't know if it's going to help them with their mortgage, but let's hope it does. Not every day you find $10 million worth of gold coins.
Absolutely.
Not every day, not every lifetime. Okay, one more thing for Rob.
Yeah.
Off air, we were talking about these equity investors type people.
Yeah. We were in the last segment. We were talking about some of the things we've seen, and I was doing a rent versus own calculation for a program that we have that's specifically targeted at the jumbo borrower here in the Bay Area. Well, it could be anywhere in California, but specifically what this program does is it matches the borrower's down payment. So let's say you're buying $1.5 million property. And you want to put it down only 10%. Well, this program will allow you to do that. So, in that case, you're going to bring in $150K, and then the down payment funding program is going to match that $150K, and that's going to be your 80%. So what I did is I did a rent versus own, because you have to figure that if you're renting a property in that range, you're going to be paying quite a bit of rent. Let's say $5,000 a month or something like that. And rent versus own, for those that may not be familiar with it, it takes a few things into consideration. It takes into consideration how much your rent will increase percentage-wise over time. It takes into consideration how much you expect the home would appreciate over time. It takes into consideration the amount of money that you would otherwise not invest in the property if you continued to rent. And it takes that at a certain rate of return over, again, the period of time that you're looking to do the calculation. And also your tax bracket. And it takes all these numbers and it does the math on them, and then it comes back and it says your benefit, or, the benefit to renting or owning is this or that.
And is this a specialized program?
It's a specialized program. Well, you can find
That's
them online.
one heck of
I'm
a
sure.
spreadsheet.
Yeah, and believe me, some of my borrowers have done that. But no, they're readily available online, and we certainly in our loan origination software we have that. So I was doing a calculation on this because it's not your money necessarily that you're investing in this property, all of it anyway, because you're getting the down payment funding. And I'm finding that on the higher end properties, some of these over a 7-year horizon are paying the borrower more than $200,000. So in other words, you come out ahead, rent versus owning, you come out ahead to the tune of anywhere from $100,000 to $200,000 over that period of time. And I was startled to find that. And it's a combination of the fact that these individuals are in a high tax bracket. The interest rates on some of the programs that they're putting as a first mortgage are very low.
Yep.
And also the fact that I'm not even giving them the benefit of the doubt with the appreciation, and I'm not giving us, as the lender, the benefit of the doubt with the amount of rent increase. So I'm being, saying the rent increase would only be 1% a year, and maybe the appreciation on the home would only be 1% a year, and they're still coming out ahead. So I think that's very encouraging for buying. Let's see if there's any inventory for them to purchase. But this helps them go up in price point if they have to.
It would make a difference if they could rent that $1 million property for only like $800 a month.
Well, very much so, very much so.
Yeah.
But that's hard to find, and a lot of landlords in this tight market recognize that too, and they're saying, hey, your rent is going to be increasing. I talked with a borrower who was possibly staring down a $1,500 a month rent increase because the landlord knows, hey, look, the rental market is en fuego here.
Oh, it's amazing. When you said $1.5 million house renting for $5,000, I think you would get
Yeah, right. No, and
and
again,
depending on where in what neighborhood, if it's anywhere in
Yeah.
San Francisco, that rent could be $7,500, $8,000. I mean, it's just
well,
really
and
amazing.
that's what I'm doing is I'm being conservative. I'm showing the potential buyer, hey, look, this is maybe a worst case scenario, and your rent versus own is still looking very encouraging. So I think that offsets or must be perceived as being an offset to the high cost of living and high cost of buying.
Do you have the people who are willing to put up the other?
Oh yeah, that's a company we work with directly, and they have chosen RPM to be a first mortgage partner on that. So it's all done in house. We have that relationship with them. They're extremely helpful. The company that does the down payment funding, their account exec will get right on the phone with our borrowers.
So it sounds like it's ideal for somebody who doesn't have the whole down payment,
Right.
but makes enough income
Right.
for the ability to
You hit the
repay.
nail on the head. You hit the
Yeah.
nail on the head. They've got the income. They either don't have or do not wish to liquidate or take out of the market or whatever other reason, use the entire down payment. And remember too that jumbo loans, and this is with most investors these days, not only is it the down payment you need, but you need the reserves post-close. So the lender needs to know you have a cushion in the bank once you close the loan that equals a certain number of months of your housing payment. So you've got to make all those variables work to get a jumbo loan, and this program, the down payment funding program, is very helpful in some of those scenarios.
Second commercial break, very quick one here. The theme again is celebrity car accidents. Which Star Wars actor went through the windshield of his Corvette shortly after making the first film of the trilogy? Don't touch that dial. The Best of Investing will be right back. Welcome back to the Best of Investing. I'm Edward Brown, your host, along with Mark Hunt and Rob Spinoza. When we cut to the second commercial break, again, the theme is celebrity car accidents. Which Star Wars actor went through the windshield of his Corvette shortly after making the first film of the trilogy? And I gotta say, with all the characters like Yoda and R2-D2 and C-3PO, they all look like they've gone through a Corvette.
It couldn't be Yoda, though, because Yoda was in the second one.
That's
right?
correct.
Okay.
So the answer?
Mark, you got it?
No, I don't.
Mark Hamill.
Okay.
Oh, we did.
Luke Skywalker.
Ouch.
Luke Skywalker.
He did look like he had some scars later on.
That's exactly.
That's called that's using the force.
Yeah,
The force of your forehead.
Force of his
your
face
forehead.
against the glass.
In fact, I think they ended up using part of the scars for the second one.
Oh wow!
Yeah, they kind of made reference to it. Like
What a
you got it
brilliant
from
set of
somewhere.
movies, though, man.
Pretty cool. I liked The Empire Strikes Back.
That was a great movie.
And if it
Great
was
movie.
baseball, it was the Empire. Here's our thoughts for the day. Got to cut out, guys. Thoughts for the day. More than 10 people per year are killed by vending machines. I told you those bags of Cheetos were very dangerous. And when a massive power outage struck Southern California in the 1990s, Los Angeles residents reportedly called 911 to express alarm about strange clouds hovering overhead. The reason? They were seeing the Milky Way for the first time.
Wow.
Isn't that wild?
Yeah.
All right, tune in next week to The Best of Investing. We're going to be giving away 9 more free vacations for answering trivia questions. Thanks for listening. On behalf of our team, I'm Edward Brown. We're wishing you the best of investing. So long.